All right, well, thank you very much this evening. Thank you, everyone, for joining us tonight to learn a little bit more about our economy as well as our town hall meeting. So today I'll be going over a presentation and sharing some thoughts and ideas about the economy, the financial markets, and investing in general with you. And at the end, we will go ahead and capture your questions and answer all of them for you. So if you write those down as we go through my presentation this evening, and then if you don't by chance have your questions answered by possibly watching this video later, you can email us at hello@hiwealth.com. We'll be happy to answer any questions that don't get answered during our presentation today. Well, today, in talking a little bit about the economy and the financial markets, we're going to talk about all of the things that you're dealing with right now. And secondly, we're going to talk about the being human problem. That's certainly the challenge that we have beyond all of the things outside of us. We also have to deal with everything inside of us. The third is we're going to talk a little bit about the importance of staying invested, diversifying and rebalancing, and how you can take 3 steps for more comfort and confidence. Just this week, I published a blog post about the 3 steps to convert your worries and concerns about investing into more comfort and confidence. So if you look at our website at hiwealth.com, you'll see that blog post and be able to see more details, but I'll be covering those 3 steps in general with you this evening. So right now, you are dealing with a lot of things. When we take a look at everything there is that we're taking in and dealing with, we are now in year 3 of our pandemic. Although a lot of restrictions and precautions that we've been required to take over the last few years have kind of diminished over time. And with vaccinations, we know that the virus itself is not as deadly or as serious as it has been in the past for many of us. It is still an item that's weighing on our minds and affecting our economy. We're also, I don't know about you, you may have noticed that our financial markets may feel a little bit like a roller coaster these days. And actually, the volatility that we've seen in the financial markets has picked up and has not seen a similar level of volatility since 2008, the Great Recession and the financial crisis that we saw back in 2008, 2009. So that bumpy ride is certainly creating a lot of worry and concern. That's something that we want to address this evening. We're also fighting inflation. There are a large amount of inflation. Over the last month, we saw inflation running at an annualized 8% level. And there are a lot of factors coming into that. Whether or not many economists thought that it would be kind of a little bit of a blip as the built up demand from the pandemic got released, but still we're seeing some challenges with supply chain issues with some items coming into stock. Although I just read a headline today about cars that automobiles are starting to catch up with demand, and actually inventories at dealerships are starting to grow. So we're starting to see a little bit of ease in that, as well as other areas like lumber, for example, has now reached the pre-pandemic level in price. So that level has come down. But there are still many things that are influencing inflation. One of those is that the continued war in Ukraine, that is not only influencing world economies through a shortage of grain that has not been able to leave Ukraine as much as possible in the past, as well as certainly not as much as being grown and harvested, but also just from the restrictions placed on Russia for the aggression in Ukraine that is hampering the energy sector. Certainly we have seen over the last month and a half the price of gasoline come down in the United States. But still, the European Union is struggling with a lot of challenges around energy, since Russia plays a large role in supplying that. And so we're going to continue to see the impact of this conflict ripple through the global economies. And also, we're continuing to see a tight labor market. There continues to be more job openings than what we see individuals participating. Our unemployment rate is down to 3.7%, which is at a 50-year low. And this also is contributing towards inflation. Employers need to offer higher wages and salaries, as well as other benefits that they're rolling out to attract new employees, as well as just hold on to the employees that they have. It's one of the reasons why we're probably not going to see a lot of layoffs, even though we may see a recession come into play from interest rate hikes. That big R word, recession. Technically, we are in a recession right now. The first 2 quarters of 2022 were negative growth rates for the national gross domestic product, which is the technical measurement of a recession. But one of the reasons why I don't think that we'll probably see layoffs like we typically would with a recession is due to the fact that it is so hard to find good quality employees to hire. I think that the airline industry is in a prime example of, in the pandemic, they did everything they could to pare back their personnel during the pandemic, encouraging people to retire early, as well as encouraging people to find other jobs. And then when the travel industry came roaring back this year, they had a very hard time and are continuing to have a hard time on hiring additional flight crews to expand on that. And so I think large employers are going to see that and continue to keep that in mind, as if we do see a weakening of the economy, that it may not be in their best interest to have layoffs if those are indeed positions that will need to be replenished potentially when any slowdown in the economy retains or starts its growth again. Now, related to that, as I mentioned, in heading off of that inflation, the Federal Reserve has raised interest rates for 5 times this year, and it has been a substantial and steep increase. You'll see by this chart here on the far right that we started this year with the Federal Reserve rate right around 0.25%. And through these 5 dramatic increases, we're now right around 3.25%. And the Federal Reserve is projecting that rates may be as high as 4.4 or 4.5% before the end of the year. Now, keep in mind that the financial markets already have priced that in, since the Federal Reserve has been very transparent on their kind of focus on making sure that they get inflation down as quickly as possible. But it is something that has directly impacted all of our portfolios. When interest rates rise like this, a whole like 1,200% in a matter of months, we're going to see the value of bonds go down in value. The value of bonds works like a teeter-totter, that when interest rates go up, the value of bonds goes down. So we're seeing that even in our portfolios, which focus on short-term, high credit quality bonds. Now, the short-term bonds have not had as much fluctuation as a longer-term bond or a higher risk, like a junk bond, or what we call a high yield bond, which are lower credit bonds, which we stay away from. But we're still seeing an impact on short-term high credit quality bonds. But a couple of things to keep in mind with that, because now in this year, we've seen not only the stock market come down, but the bond portion of the portfolios come down, is the benefit of owning short-term bonds is that we do see those regaining value as they approach their maturity date. So When you have a 2-year bond, for example, that was purchased back in 2021, and the interest rate may be around 1%, whereas now a 2-year bond is closer to 3.5%. Certainly the value of that bond from last year is going to be lower to make the yield on it a little bit more attractive. However, when it comes up to its maturity date next year at the end of its 2 years, as long as the government or the corporation that issued that bond is still in business, we'll see the value of that bond gradually come back up to its full face value. It's one of the reasons why bonds provide stability in our portfolio, is that we know that the government or corporation that's issuing that bond is making a promise at the maturity date they will repay the full face value of that bond back to the investor. So we should see the value of those short-term bonds not only come up towards their face value at maturity, but as they do mature, we're going to see the turnover in those bonds, that the new bonds purchased in the portfolio will have those higher dividend yields. So not only should we over the next year or two see the value of those come back up, we should see the dividend yield increase as newer bonds get added to the portfolio at higher yields. So that's a couple of the highlights in optimistic outlook for short-term high credit quality bonds as part of our portfolio going forward. Now, for any of you that may play the game of golf, which I am one of them, it's commonly talked about that the game of golf is played on a very small course, just 6 inches wide. And that's because it's right here. A lot of what we think mentally impacts our game of golf and also impacts the way that we act and behave as investors. And the important thing is to realize that, to make sure that our emotions, our instincts, and our perceptions of being human don't influence our investing process at the wrong time. And an example of how that human behavior influences investments, I'd like to share just a little bit of information from the 2022 study by dalbar. Dalbar, over the last 30 years, has analyzed investors, taking a look at how they have performed as an investor compared to markets as a whole. And just as a quick overview on taking a look at how stock market investors, or at least the portion of their portfolio that's invested in stock mutual funds, has performed, what we see over the last 30 years, just to keep up with inflation, you would have need to have a return of around 2.36%. So if you invested $100,000 30 years ago, at the end of 30 years, it would have grown or need to grow to 200,000 just to keep up with inflation. Now, the average investor, taking a look at how they performed in that time frame, averaged around a 7% annual return over the 30 years. Now, you may be saying, well, 7% is not bad. I'm happy with 7%. However, when we take a look at just one measurement of the stock market, for example, the Standard & Poor's 500 index, which is an index made up of 500 of the largest U.S. companies, during that same 30-year time frame, it averaged 10.65%. Excuse me. So just investing in the S&P 500 index, you would have averaged over 3% per year more than what the average investor earned. So that same $100,000, instead of growing to about $800,000, would have grown to over $2 million, a substantial difference. So the one thing to keep in mind, though, is that an index cannot be invested in. It's just a measurement of those 500 stocks. But there are index funds and index ETFs, or exchange traded funds, that do follow that index. But there are going to be some costs involved with that. So it's not going to be a complete mirror if you try to match that. But you can clearly see the difference between what active investors are earning compared to at least one market index. And that doesn't include other market indices like small companies that have performed better than the 10%. So why is that? Well, it's because of our emotions. You see, we have this tendency that as the market or specific investments start to climb, start to improve, we become encouraged and confident. We may even become thrilled when it starts getting really high. And typically that's the time when investors feel comfortable enough to start putting money into the market, into investments or a specific stock. However, it's not too long after that euphoric state where we then start to get a little surprised that it starts to sell off. It's overvalued and starts selling off. We become a little bit nervous, a little bit worried. And then we hit a period like we saw last week where the market sold off dramatically and we become a little panic stricken. And that's when many investors sell off towards the bottom of the market. So rather than following the golden rule of investing of buying low and selling high, many investors do just the opposite. They buy high because they feel comfortable, and then they panic and they sell low. And as a result of that, time and time again, that's why they underperform the markets as a whole. And when we take a look at how investors kind of get performance statistically, it's pretty shocking, the difference. In this study by BlackRock, when they took a look at what they call following the herd, by taking a look at periods of times by inflows and outflows out of stock mutual funds, where they see large amount of inflows coming in, the herd's coming in. When large outflows are going out, the herd is going out. And what they found is when individuals followed the herd by buying high and selling low, in the following 3 years, they earned an average of 5.5%. Even though in this time frame, the average of the Standard & Poor's 500 index, again, as a measurement of the market, only earned 10.7%. Yet those that went against the herd, those that bought when others were selling, realized an average rate of return of 15% per year for the 3 years afterwards. And so it shows that it's important to not follow the crowd. When you start hearing everybody talking about sell, 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 usually that's the time to buy. You know, my partner Scott Iles and I, we were just talking the other day that usually when we start hearing the phone ring and people getting nervous about the markets, it's usually our indication that we're getting close to a bottom in the market, because that is truly when the market hits a bottom, is when everybody who is panicked or encouraged or feels like they need to sell has sold. And then it creates an opportunity for those that are going to take advantage of that to buy in. And that's one of the largest transfers of wealth from the sellers to the buyers. Now, when we take a look at being human, another aspect that we have to deal with is that we have biases. And as a human, we have over 180 biases. Now, if I had the next couple of days to sit with you, we could go through all 180 to make sure you're well informed, but we're not going to do that tonight. Tonight, I'm only going to highlight 3. These 3 are those that I see most often and want to make sure that you're aware of, so that you can be aware of them. So when you kind of experience it for yourself, you can say, hey, that is my recency bias. Now, the recency bias is the fact that we tend to focus more on things that happened to us recently than over the long term. So let's look at the S&P 500 index for an example. Now, this year, as of last Friday, September 30th, the Standard & Poor's 500 index is down around 24% for this year, for 2022. Now, you may be saying, this is a miserable time to be invested. However, if we take a little bit of a longer perspective, it's amazing that how quickly we forget that 2021 was a great year in the financial markets. The Standard & Poor's 500 index in that year, on a calendar year basis, was up over 26% for the calendar year. So when we see that the markets are down 24%, we were up 26% last year. We're actually still ahead of the game if we take a look from January 1st of last year through last Friday. But yet we tend to focus on just the recent period of time. And the same holds true if we look back even further. In March of 2020, in a period of 3 weeks at the beginning of the pandemic, from March 2nd to March 24th, we saw the financial markets drop off by more than 20% like that in 3 weeks. But yet, at that bottom from March 24th through the end of the year, the S&P 500 index was up 53% between that bottom and the end of the year. And if we go all the way through the end of 2021, from the bottom, the markets were up over 95%. But yet those that panicked during the beginning of the pandemic never experienced that because they were focused on the recent short-term loss. Now, one of the other things I just wanted to highlight tonight that I find interesting is that why is it that in 2020, we lost over 20% in just 3 weeks? And here we are in 2022, and we've lost 24%, but over 9 months. And yet we feel still more uncomfortable now than we did back then. Well, one suspicion that I have is back in 2020, it was almost like ripping the Band-Aid off. When it was a short 3-week time frame that the market went down, we just had one statement that came in with a big drop in it, and then we started to see the markets regain value in subsequent months. Whereas this year, although we did have a good month in July, and we've had other months that were positive, for the most part, we've had a number of months with negative returns. And so we hear month after month of negative returns. August is down, September is going to be down. And that recency just kind of builds in negative thoughts in our mind, and we tend to hold on to those negatives more than the positive. So be aware of your recency bias. Make sure that you maintain a long-term perspective, because we are invested for the long term. We don't know what the next 10 or 20% move will be in the financial markets, whether it'll be up or down, but we do know that over the long term, the next 100% will be to the upside because the market trends upward over time. Now, another bias, and I alluded to this just briefly, is herding bias. We have to be careful that we're not caught up in herding. You know, one thing that's being talked a lot about right now is cryptocurrency. Everybody, let's join in. Every famous football player and star and influencer on Instagram to buy some cryptocurrency. They're starting to regret that now as they pay some fines that are coming out. But there's this herd mentality and our fear of missing out about cryptocurrency. And if you're asking yourself, what is cryptocurrency? And should it be part of my investment portfolio? We encourage you to attend our cryptocurrency workshop that we'll be hosting next Thursday on October 13th, I believe it is. And we'll show that date again. But you can go to our website at hiwealth.com for more information about our upcoming events. Now, another bias that we have to deal with is our confirmation bias. I talked about the fact that we may or may not be headed for a large-scale recession or a slowdown in the economy. But if in your mind you believe that we're headed for a recession, you will naturally have a human instinct to search out and look for the news stories, the headlines that will confirm your belief that we're headed for a recession. On the other hand, if you have a more positive outlook, you will start to look for those positive things, although they're harder to find. You'll find that you'll need to look for things that confirm the way that you believe. And it's our natural bias to want to find facts that kind of build up our argument of what we believe. It's kind of interesting the way that our mind works, that actually our emotions and our subconscious make most of our decisions, And then after the decision is made, it's our rational mind that then tries to find the evidence as to why that was a good decision. I mean, you can just look at the last time you picked up that candy bar at the cash register going out, right? It was that emotional grab that you just had there. Looked good. Now, the media knows that we have these biases. And it's one of the reasons why they continue to put out headlines of negative news, because they know that we have a tendency to click more and pay more attention to negative headlines than positive. There's actually a 60% differential here between what we would click on as a positive headline, using words like always or best, versus a negative headline saying never before, or this is the worst time ever. So it's important to remember that the media plays on our biases and our instincts to want to confirm the way that we believe. It's also important to realize that the media is not out there to really serve you. The media is to sell Suggies and My Pillows and everything else that they want to start selling leading up to the next holiday. Anybody know how many days till Christmas? I don't even want to think about it, but it's about that time that we'll start hearing all about that. But they're there to sell advertising. And so they're going to play on our fears and our biases to get our attention, to attract our eyeballs to that news media, to the story online, to click, to have us to read more. Now, through all of this, we need to stay invested despite the challenges that we are facing through inflation, volatility in the markets, concern about the war in Ukraine, a tightening labor market, and all of the things that we deal with personally as a human being. We need to focus on staying invested. And here's a couple of reasons why. First, when we take a look at portfolio performance, there was a study performed by Gary Brinson, Randolph Hood, and Gilbert Biebauer, and they studied where do returns come from in a portfolio. And the amazing thing is that you'll see that market timing is only a very small sliver. 1.8% of returns comes from the time that you came in or came out of investing. About 4.6 is from stock picking or the selection of the investments. But really the majority of the performance, 91.5% to be exact, comes from asset allocation. How is your portfolio diversified and how is it built? That is where the majority of return is going to come from over time. It's why we believe in using academic investing principles on developing portfolios so that they are properly diversified and engineered to withstand volatility like we're seeing today. Now, the other reason why you need to stay invested is because it makes a dramatic difference to your portfolio. If you take $100,000 and you invested on January 1, 2002, 20 years, you let it ride without making any changes, you would have seen your $100,000 grow to $616,317. It would have grown 6 times over. But the amazing thing is when we look at a period of 20 years, just missing 5 of the best years out of, 5 of the best days out of 20 years, your portfolio return would have been slashed by 37%. Your $100,000 would have only grown to $389,000, not by missing a year, 2 years, 6 months, only missing 5 days. And that is amazing that even if we miss as many as the 25 best days, not even a full month out of a 20-year period, the return is drastically reduced to only about $134,000 on your $100,000 originally invested. Can you imagine investing $100,000 and 20 years later, it's only grown to $134,000? You stayed invested the whole time, but you tried to time the market and you missed the 25 best days. That's all it takes to pretty much wipe out all of the return. It's the most important reason why you need to stay invested, because we don't know when we're going to see a rise. Just like the last couple of days in the market where the indices have gone up by over 2.5% per day in the last 2 days. If you're sitting on the sidelines trying to wait for that feeling of comfort and peace of mind of going in, you're never going to be there to capture it. And you may make a dramatic impact of your long-term investing success. So when we're looking at investing, there are 3 simple rules to follow. But the challenge is it can be difficult to follow rules. It's just like trying to maintain a healthy weight. I need to exercise and move more. I need to eat less and eat the right things. However, somebody in the office brings in a box of donuts and boy, those looked really good today. And it's hard to follow those simple rules to maintain health. Now, fortunately, that donut I ate today is not going to drastically impact my health for the long term, but making one investment mistake can have a dramatic impact on your long-term financial success. And so it's important to follow these 3 simple rules. The first is to own equities, and that everyone should have some portion of your investment portfolio invested in the stock market. This doesn't mean that everybody needs to have everything in the stock market, but a portion should be invested in the market based on your risk return preference. Because the stock market is going to be the best way to hedge against inflation. Just as a side note, I know it used to be a few years ago, rather than cryptocurrency, it was gold, gold, gold. Everybody should be buying gold. That's a perfect hedge against inflation. Well, guess what? Gold is down 9% this year. It didn't do so well hedging against inflation. The second is that we should be diversified globally. The US has had a very good run the last several years, and so international performance has trailed over that time frame. But there's no guarantee that that will continue. And historically, looking back, we know that it won't continue, that there will be periods of time when the international markets perform better than the US markets. And so it's important to be globally diversified. And our investments through Matson Money are invested in 80 countries around the world. The third is that it's important to rebalance. Now, when we have a portfolio, let's say that's 50% stock and 50% bonds, it's a moderate allocation. And last year in 2021, it was a great year. The portion in stock increased by over 20%. And so that 50% is now worth 55 or 60% of your portfolio. Well, if you just let it ride, saying, hey, we're got momentum, let it ride, you actually have more risk in your portfolio now than you did when you started the year. So it's important to rebalance. So while the market is high, we'll trim back a little bit of that stock portfolio and buy more bonds to bring it back to that 50-50 target. And we do this process every 90 days. So at the end of every calendar quarter, we systematically look at every client account individually to take a look at where those percentages are compared to your target allocation. And if it's more than 5% away from that target allocation, we're going to rebalance it back. Now, just as a little side note, there's also rebalancing that's going on a daily basis within the investments. But I'm not going to go into all that detail right now, but there's rebalancing that needs to happen. And in most cases, we're taking care of that for you. But if you are self-managing a portfolio, it's important to follow these 3 simple rules. And in most cases, I have yet to see a self-managed portfolio that's being rebalanced on a systematic basis. Now, as I mentioned, the blog post that we posted this week were 3 steps to lead from worry and concern to more comfort and confidence. So I wanted to take just a few minutes to talk a little bit more about those 3 steps and how they may help you if you have some worries and confidence, lacking confidence, or some concerns about whether it's who's in the White House, about who's running Congress, what's happening in the economy, all of those things that we could have worries and concerns about. Well, first of all, the first step is to identify those worries and concerns. And the things that I want to point out is that there is a difference between a worry and a concern. In our blog post, we talk about the fact that a worry is defined as to torment oneself with or suffer from disturbing thoughts. It's kind of a scary definition of a worry, self-torment. But the truth is that a worry is something that we create ourselves. A worry is something that is related to something that's out of our control that we put in place. A concern, on the other hand, is defined as something that we relate to, are connected with, or have an interest of importance to. So it's something that we actually have connection to and can have some control over. And that is why it's important to distinguish the two, because the second step is to let your worries go. You can't control what you can't control. So there's no need in worrying about it. And I know that's sometimes is easier said than done, but that'll get tied into our third step. But when you have a concern or something that you do have control on, you can act on it. If you have a concern, do I have too much risk in my portfolio? You can act on that. You can have Hammond Iles do a portfolio MRI and analyze your portfolio to determine how much risk you have in it. We can have a conversation around that. So the benefit of having a concern is that you can act on it. So by determining what those are, you can take action rather than allowing that self-torment just weigh on you and give you anguish and fear. And the third aspect of that is you don't have to do it all alone. You can get support. And one of the best ways of getting support is being right here in our online workshops, being part of a community of like-minded investors so that you are not alone. Everybody here in this room has the same worries and concerns that you do. And hearing other people ask questions or hear their comments can give you that comfort of knowing that you're in a community and that people are facing some similar things and that they're here to learn about the actions they can take to address those concerns. The other support is to reach out to your financial coach at Hammond Iles. We are here to support you and your family across 3 generations to live a life of freedom and fulfillment. So reach out to us with your concerns. Perhaps we need to put a financial plan in place so that you have more clarity on the path forward so that you can have more comfort and confidence in your financial future. Maybe you need to have your portfolio analyzed or revisit the risk return preference that you set up in your portfolio if your life circumstances have changed. We are here to support you, and that's one of the ways that you can have more comfort and confidence about your investments. You can learn more about these 3 steps in our blog post, and again, you'll find that at hiwealth.com. So just to kind of summarize how we can help, we can meet with you and your family members wherever they may be. I know a lot of family members can be scattered across the United States or even around the world. And thanks to technology, we can bring everybody together. The important thing is in our dedication to you and your family, please be aware that Hammond Iles Wealth Advisors has no minimum to start investing with us. Our youngest client is 10 years old. Our oldest is 103. We have a wide spectrum of children, grandchildren, parents and grandparents, all part of the Hammond Iles family. We also have conversations where we bring families together to talk about financial planning. Money is one of those issues that doesn't get talked about in the family. We have this no talk rule in many families that we just don't talk about how much money we make, how much things cost. And as a result of that, generation after generation, our families experience and repeat all of the same bad mistakes, bad decisions, or investing mistakes that we made, that had we just shared it with our children and grandchildren, they would be able to avoid it. So we can have conversations where we bring families together to talk about investing in general, as well as potentially talk about the family as a whole and how we can work together for everybody's financial success. We've had grandparents that have the financial means to help out their grandchildren with college loans, but unless there's a conversation there, neither party knows that they can help each other out. And certainly one of the other ways that we help are through our continued investing in financial literacy classes, through these live sessions, or through our recorded sessions that you'll find on YouTube, that you can also find links to on our website at hiwealth.com. And on the investment side, to create more comfort and confidence, we carefully manage and rebalance portfolios to minimize your risk and maintain your level of risk so that you can achieve what I call the swan effect, the ability to sleep well at night. So these are some of the ways that the financial coaches at Hammond Iles can support you in taking action on your concerns. So before I wrap up and we look to move on to hearing your questions, I just want to thank you for taking time out of your busy schedule to spend it with us. So that will wrap up my conversation and presentation for tonight.